Welcome back. So I appreciate you guys tuning into the second portion of this brief. Second portion is, as we can see, we got our budget, that's the first piece, and we got retirement. So work towards your retirement. Over here we got a good picture of that. And over here we have steady growth. So what we should work towards retirement is something that's low risk and that's a stable investment. That's what we should work towards for our retirement investment. Something that's going to be there. Now, some people will say that you can incur more risk when you're younger, and that is true. But again, my model is trying to promote peace and stability. So first you provide or work towards something that is stable, that is going to be there. And here I have a few examples. So from Roth IRAs to TSP if you're in the military, mutual funds, which is a collection of stocks, more diverse, to certificate of deposits that, of course, have a bigger certificate of deposits that are with the bank. And it depends as far as if the certificate of deposit will compete with the rate of inflation or not. So CDs are very, very stable. Unfortunately, sometimes they cannot be the best investment. But I figure I'd put them up here anyways as far as an option. One thing I'd figure I'd note for everyone that's listening to this, if you're born after 1980, just the way I see the country going and everything, I would not depend on Social Security being there. Just with how, I guess, the balance of people contributing towards Social Security and the amount of people like getting from it, in some way, I would imagine that legislation is going to change. So if we want to talk about a pyramid scheme, this is actually a perfect example of one, Social Security. But I don't want to get too much into politics here. But moving forward, so what does retirement look like for you? How do we build that? How much money do you want to spend on an annual basis, or monthly or annual basis? When are you going to be retired? What will you be doing to keep yourself busy? These are all important questions as far as what you should ask yourself regarding what your retirement is going to look like. So the first one, how much you're going to spend on a monthly or annual basis, you're going to know that by if you do the monthly income expense worksheet. You're going to know what you spend on a monthly basis on average, with kids, without kids. So you have a pretty good idea as far as how much you're going to spend in retirement. Ideally, it'd be less, especially if you own your house, you own your car, you own the land that you live on. If you own everything that you had a mortgage for or a loan for, then there's a lot less expenses. So here I have an example listed out. I'm not going to read it to you. But ultimately, we have the person, we have where he wants to be, which is Washington State at this time, and we have the age as far as how when he wants to be retired. Both of them are going to have it saved up to 1.5 mil through the various different methods and have an average of spending about $3K per month. Which $3K per month is probably a little bit high, but it's better to be high in your estimates. It's better to like try to gain more or push more towards for retirement because you never know what might happen. So it's better to be stable. And then stay busy. Here we have like some hobbies that they're going to be doing to keep them busy as well. Because it's good to stay mentally and physically active. It's good to invest in your community continually. There's a lot of different reasons, both mentally and just being a good person and having that peace and stability for yourself. You can allow others to have peace and stability as well if you volunteer or try to give towards your community. So here's this example, and 1.5 mil might seem like quite a bit, but I'm going to show you via the numbers here in a little bit. For two people saving up, it is actually very attainable. And here we have the example of the Roth IRA/IRA. Now there's a difference between the tax break as far as like when you pay taxes. With an IRA, you pay your taxes on the front end. With a traditional IRA, you pay your taxes on the back end. So with a Roth IRA, pretty much you're betting that you're going to be in a lower tax bracket by the time you pay your taxes. So here we have a relatively low amount. This is a very traditional conservative model. So currently you can max out your Roth IRA contribution by $6,000 per year. And from that, we have year one, And there's a growth of 0.3%, or excuse me, 3%. It's 0.03 or 3%. And then this is what it, of course, accumulates to. So if we do that for 50 years, put away $6,000, let it accumulate the interest, here's what it comes down to. It comes out to nearly 700K, and that's for just one person. The amount, or the principal that was initially put in, is 300K, and the interest gained is nearly 400K. So by continually pushing that money away and letting it build interest, that is the amount of interest gained. That is what it's going to be, how much it's going to be when you can dip into the retirement. So these are the numbers here on the left. Then on the right, here I have the equations. So you can actually see the math behind it. Of course, you can do Control tilde or Control squiggly line on your keyboard to be able to switch between the formulas and the numbers. So once you have built towards your retirement, the final piece is growing your money, doing something that's a little bit more risky. And again, with peace and stability, once you're out of debt, or once your debt is sustained or in a sustainable aspect or position, and then you can start putting away towards retirement. Once you have money towards retirement put away, then you can start to grow your money. And growing your money is going to be putting money into a little bit less stable markets or individual stocks. So here we have an ideal unstable growth. So we've got highs and lows, and ultimately you're going to try to buy low and sell high. That's what you're going to try to do. But sometimes with emotion, it definitely plays at you. So sometimes you'll you'll sell low. And this is what I was just talking about: buy low, sell high. And these are some of my initial tips. You should know what you're investing in. So if you're going to pick individual stocks, great, awesome. I would say pick about 5 stocks. And this is relatively a happy medium between being diversified and also being able to track what you look at. I recommend you looking into Google Finance as an example to do your research and seeing the different trends. And also you can get updates as far as when your stocks are going to go significantly high or low. It's a good way to track them. Also, if you have less stocks, this means that you'll have less to report on your taxes when it comes time for tax season. Because yes, you do have to report your earnings on stocks and your taxes. And finally, I would invest in companies that you know about, that you're interested in. And this will make researching easier and more entertaining for you. Consider hanging on to a stock for more than a year, specific for tax reasons. Only sell if it's unsustainable growth. If it suddenly spikes, if that stock suddenly spikes, then I recommend selling whenever you think it's reached a peak. Because if there's a point where sometimes you'll reach unsustainable growth and you know it's going to go down, so might as well sell while it's high. And no one can predict the future. You can get some of the best advice. You can get, you can look into different things, read different books, make great investments, make great choices. But if stock drops, consider buying into it again, because it'll be at a cheaper price. So again, buy low, sell high. There's multiple different ways to buy. So here I have a specific example of Microsoft. And if you'll notice, this is just within the past 6 months. And this is taken off of Google. So this is something you can simply come up with. Just Google finance, just put in the words finance, and then I'll take you to this application. And then here's a little depiction as far as what it means. There's multiple different ways to buy and sell. So market is buying instantaneously at that moment. So that is when the best price available What the current cost is at the moment, that is how much that is what a market buy is. For a limit buy, here's where the blue dot is where the limit is put in. Then the green line down here is where the limit is actually set at. So when the market goes down, hits a certain price, that's when the order is actuated or action upon. That's when the order is when there's action taken upon it. And then if the stock price goes back up, then great, awesome. You bought at a low point. Same thing with the sell limit. So it takes a while to figure out as far as the differences between a limit and a stop. Ultimately, with a limit, you're trying to predict as far as where the price is going to go. With a stop, it's kind of putting like a fail-safe in place as far as you don't want it to go past a certain point. Also in the Excel spreadsheet, there's a separate tab as far as how much money you can make off of stocks. So I just have some fake symbols here and just initial amounts as far as how much you should have or how much you could typically have invested towards each individual stock. And then the profit loss margin. So based off of me personally trading, these profits and losses are very manageable based off of when you buy and sell. And I'll be honest, right now I've kind of broken even to this point, but I've continually bought in at low points, and hopefully eventually those low investments will make dividends, will pay off. So again, my recommendation here, use Google Finance to watch and trade or track stocks or track stock activity specifically. It's great. It's very accessible, and also you can get notifications. So again, the reasons behind this peace and stability is that it's more stable, less stressful. With more stability, there's of course less stress. You'll make smart decisions. And also you'd be truly happier. Instead of trying to make a quick, dishonest gain, you're going to be providing a slow, supportive, progressive approach to how you buy and sell, to how you put money away, to how you work yourself out of debt, to how you work in general. So again, more stable, less stressful. And there's multiple different images that I've taken from the internet. So here's a short bibliography of that. And this is the end. This is the end of the personal financial management class. If you like it, please like it. I plan on pushing this on YouTube. Please add some comments, whether you'd like to see something more. And also, please stay tuned for a couples financial management course. And this is going to be based off of this personal financial management course model. But the couples financial management course will, of course, depend on multiple different variables. We'll have some graphics, will be relatively short and simple and implementable as well. So thank you for listening. Appreciate any comments or feedback you may have, and have a great day.